Kenya's Monetary Policy Committee meeting this afternoon to decide on what is likely to be a rate cut. All major analysts surveyed expect a rate cut. The central bank rate currently at 13%. Some analysts even think it belongs in the single digits. Let's ask somebody clever. Paul Mwai, CEO of AIB Capital. Welcome back to the program.
Thank you, Larry.
If you sat in the MPC this afternoon, what would you be voting for?
I'd be voting for a cut, but a small cut.
What is a small cut?
I'd say 1%. I know previously we've been looking at 1% as a big cut, but yes. I think given the history where we went up to 18 and back, I think 1% is a small cut at this point in time.
Why would you be going there for that 1% cut?
I think there's three things that the Monetary Policy Committee will be looking at. The first one is inflation. And I think if you look at the outlook of inflation, the three things that you need to look at, one is the weather because of food prices. That looks positive so far. So it looks like inflation is still going to be coming down. The second thing is oil prices. When we look at global prices, I think going on to next month, we are expecting further falls. We're expecting at least stable to lower oil prices.
Right.
And the third is the base effect. All those point to lower inflation. So looking forward maybe for the next 6 months, we can say that the beast of inflation has well and truly been tamed. The other thing that they will be looking at is the exchange rate. And when we look at what supports the exchange rate, the balance of payment I think is still off. So that's a concern. And we've still got a big deficit on the current account. The forex reserves have improved significantly to 4.2 months import cover. So that's a positive. And the third element that they will be looking at is interest rates.
Right.
Interest rates have been going up slightly, and I think this is an opportunity for them to give fresh direction to interest rates by just giving that small drop in.
Let me take you back to the currency for just a little moment. If we could have that graph go up, because so far, when you look at the performance for the year, the shilling has held largely stable. Because remember, in October last year, the shilling was at 107 to the dollar. Mm-hmm. So it's been a huge recovery, isn't it?
It's been a huge recovery. Again, a lot of it supported by interest rates, unfortunately, because I think that's a very high price to pay for an economy to support its currency using interest rates. It's expensive, and perhaps it's short term. It's not a long-lasting principle, and the price that you have to pay for that is quite sizable. So, in my view, yes, we've got a stronger currency, but there are also other supporting factors. I think we've seen some loans coming in from foreign banks, which have helped stabilize the foreign currency.
But how long will it stabilize that? The 85 we're looking at right now, how long will it stay there?
I think overall, looking forward, in the short term, I think it will stabilize. The government is looking at issuing a sovereign bond. Yes. That will also help the foreign currency position. But on the long term, unless they correct the balance of payment, as we go into next year and the election, we might begin to see the currency begin to slip.
The argument is for a larger rate cut, maybe 200 basis points, because let's face it, inflation is at a 2-year low, 4.14%. We haven't seen this in 2 years.
Absolutely. I think there is justification for a larger rate cut.
Yes.
But I expect the Monetary Policy Committee to play a little cautious, particularly because of the exchange position. And therefore, as they go forward, they'll probably stagger that cut into a number of sessions.
What happens if when that statement comes out later this afternoon, maybe 4 or 5 p.m. Kenyan time, it's 300 basis points and we're sitting at 10% or even lower? What would be the effect of that?
That would be the effect of that would be good. I think it will give fresh impetus for interest rates to come down, and it will now give a pointer that the government is now focusing away from controlling inflation to stimulating the economy.
Because the banks right now, and this is almost a tangent but the banks are enjoying a serious spread on the interest rate.
Yes. I don't think the impact on the banks will be immediate. Again, there is always the lag effect as far as dropping interest rates. And the relationship between the CBR and interest rates is perhaps not very direct. It is, and therefore there's always that big lag. So I don't expect that the drop in a 300% drop in the rates will immediately result in the banks dropping their rates. I think some banks should drop, but it'll be slow to come.